This week we've seen strong markets and anticipation of more support from the ECB, which duly arrived yesterday in terms of an elongation of their QE programme, albeit at a slower buying rate. Here we've got the performance of developed markets since the Trump election, and here you can see the impact of the Italian referendum. We got through that, and it's allowed European markets to rally quite strongly in conjunction with that further ECB support. Perhaps most surprising has been the strength of the Nikkei, the Japanese market, and that's been a result of a weaker Japanese yen, something that the Bank of Japan have been trying to achieve for a long time, but relative to the dollar, because of the reflationary policies in the US, we're now starting to see that. Also, you've got ongoing ETF stock buying by the Bank of Japan and the government pension fund moving towards equities. So a very strong underpinning of that equity market, balanced with low valuations and pretty solid domestic data. So the Japanese market as a general reflation trade looks quite interesting here, given the government support and Bank of Japan support. This week we're going to look at the change in correlation between stocks in the US, and what we want to highlight here is that we're moving from a period of that prospect of a general P expansion in Japan now seems more likely than in the US, having seen a number of years of P expansion. What we're seeing in the US is an acceleration of earnings that's been stimulated by tax cuts and potential fiscal projects, and that's got to be offset with rising rates. On that point, in this week's podcast, we're going to look at the falling correlation between stock returns in the US market, and we're also going to look at Trump's impact on drug pricing policy in the pharmaceutical sector this week, and finally we're going to preview the FOMC meeting next week. Just looking at the week ahead, going into Christmas, the results season is very light, as you can see from here. Probably of most note is Dixon's Carphone, which we'll be reporting on Wednesday. Thanks very much.
This morning I'm going to run through two charts. The first one relates to correlations within the US stock market, and the second one relates to global investment factors or styles. So looking at correlations first, this chart measures the extent to which US stocks are moving together or correlated. So a score of 100 on this chart would indicate that all of the S&P 500 stocks are moving in the same direction to the same extent. So there's perfect correlation. What we can see is that actually we're getting a very low number at the moment. This measure has dropped dramatically in recent weeks and months. And actually it's the lowest on this measure since 2007. So what does that mean? Well, this suggests better environment for active management, for stock picking. And it also suggests that long-short equity strategies should fare better than maybe they have been for some time. This isn't showing up in the numbers yet, but if this measure were to stay low for some time, we would expect to see better performance from these strategies. Second chart relates to factors or style in terms of global stock markets. The factors being namely value, i.e. cheap stocks, momentum, minimum volatility, and quality. And what the chart shows is that we've seen a change of leadership this year in these factors, and that in recent weeks, value is now the best performing strategy or factor over the last 12 months. And this is partly because of the movement up in bond yields and the sort of stocks that favours and doesn't favour, and also partly to do with the reflationary message that's coming out of the incoming US administration. So what are the takeaways? Well, there's a strong case for having value exposure in portfolios, particularly when you look at the chart, you see that it tends to beat a different path to that of the other strategies. So the sorts of funds that we would favour for exposure to this strategy would be things like Schroeder Income Fund, Magetta UK Income Fund, and some of the global factor ETFs that give exposure to value.
Drug pricing has been in the news again this week, with Donald Trump being quoted as saying that he intends to bring the prices of drugs down. The initial market reaction was quite severe, with the S&P Pharmaceutical Index falling over 2% in early trading on Wednesday. Just how Trump intends to lower the prices of these drugs and as to whether they apply to branded drugs or generics is unclear. Either way, we expect continued noise around this issue, and not just in the US. This week in the UK, Pfizer was fined £84 million after it increased the price of one of its drugs by 2,600%. It's worth pointing out that the companies in our coverage, such as Johnson & Johnson and AstraZeneca, have broad drug portfolios, and the investment case is not based on them being able to raise the prices of these drugs. It's actually based on them innovating and bringing new drugs to market.
The US Federal Reserve is set to meet on Wednesday in what will be its final rate-setting meeting of the year. Expectations are that the FOMC will raise its benchmark interest rates by 25 basis points, with Fed Fund futures pricing in a 100% chance of this eventuality. When the Fed last raised rates in December 2015, its members forecast that there would be a further 4 raises this year. However, Chinese growth and weak economic data at the beginning of the year, and political event risk in the form of the UK's EU referendum and the US presidential election have meant that the Fed have so far left monetary policy unchanged in 2016. In order to tighten policy, Fed Chair Janet Yellen has often spoken of the need for continued progress towards the Fed's stated objectives of maximum employment and stable prices. Over the last 6 months, progress has indeed been made towards both these objectives, with the unemployment and underemployment rates continuing to fall and various measures of inflation firming. This, as well as the market's favourable reaction to the result of the US election, explains why the Fed is firmly expected to raise rates next week.